One of the biggest mistakes first-time homebuyers make isn't about credit, rates, or home prices. It's that they misunderstand what affordability in 2026 really means for the homebuyer. In this video, I want to talk about what first-time homebuyers consistently get wrong about housing affordability and why those assumptions can lead people to not buy a home when they could realistically afford it. In this video, I want to walk you through what first-time homebuyers consistently get wrong about affordability and how that can actually prevent them from buying when they could potentially afford it. There's 10 main things where I feel like homebuyers really end up making their mistake. Hey, I'm Peter.Lindquist. I'm a mortgage lender in Minnesota and have been for over 30 years, and I look forward to sharing some of that with you today. One of the biggest mistakes homebuyers make is that they equate affordability with purchase price. But lenders, in reality, focus on monthly payment and what that is as a percentage of your gross income. And this misunderstanding can really work both ways, because once a buyer gets their mind set on a certain purchase price, if they qualify for less than that, they might not buy, or if they qualify for more than that, they never really gave themselves the opportunity to consider that higher price. So this misunderstanding creates false limits for the homebuyer. Another one is about down payments. A lot of homebuyers still think that you need 10 or 20% down in order to buy a home, when in reality, there's first-time buyer programs as low as 3% down. And with down payment assistance, it can get down to as little as $1,000 out of pocket if you want to go buy a home. So if you're a home buyer and you qualify in every other way, there's something we can do to figure out the down payment. And a note on this too is homebuyers will often exaggerate in their minds the amount of additional savings and how that will impact their payment. You know, I've had buyers that say, well, I'll wait another 6 months because I'm going to save another $2,000. Well, in reality, each $1,000 only impacts your monthly payment by maybe $6 a month. So if you wait that long to save an extra $2,000, you're effectively saving $12 a month. Number 3 is that cash to close is oftentimes overestimated. Buyers panic over closing costs and they see what they are, and they are definitely substantial. And before they talk to a lender, they don't realize that sometimes you can actually negotiate with the seller to pay money towards your closing costs, or possibly all of your closing costs. This is especially true in a market like today that has more or less evened out. But the other thing is that there are down payment assistance programs available. So if you can't get seller-paid closing costs, what kind of assistance might we be able to get from the state or the community in which you're buying? We'll figure that out during your pre-approval. The fourth one is student loans. And this, again, works both ways. A lot of buyers have the misconception that because they've got student loans, they don't end up qualifying for a home. But you know what? We treat student loans like any other debt, and we take those monthly payments along with any other debts, add them into your house payment, and we calculate that as a percentage of your gross income. So we assume that you've got some other debts. But the way it works the other way is a lot of buyers have their student loans on forbearance, and therefore they're not making any payments. And so when they think they can afford a $3,000 a month monthly payment, and I see those student loans, we need to count a percentage of that student loan, typically at 0.5% of the outstanding balance, but it can be as much as 1%. So if you've got $100,000 in student loans and you're not making any payments on it, we need to count anywhere from $500 to $1,000 a month as though you were making those payments, even if they're deferred for the next 5 years. The point here is that student loans are a thing, and we need to take them into account, but they don't automatically keep you from buying a home. And the fifth thing is there's a difference between the mortgage world and the real world. In the real world, sometimes a buyer will say, you know, I feel comfortable with a payment of $1,000 a month. But when I look at their application, they actually qualify for $3,500 a month. Now at $1,000 a month, and especially with minimum down, they're realistically not going to be buying a home anytime soon. And so I like to work with buyers and talk to them about what kind of realistic monthly payments look like and whether or not that seems reasonably affordable from the standpoint of a mortgage lender. The sixth one is that rent comparisons are misleading. You know, people will just take the rent amount or maybe rent plus utilities and add and compare that to a house payment. But there's some tangible things that you're missing with rent. The first and most obvious one is building equity in a property. With each monthly payment, you are paying that mortgage balance down, and the home value traditionally has risen over time. With rent, you're actually buying your landlord's house for them. Do you want to buy your landlord a house, or do you want to buy yourself a house? The seventh mistake homebuyers make is that they feel like waiting automatically improves their affordability. It's as though monthly payments are going to be better in the spring than they are in the fall. But that ignores the reality that mortgage rates change. They change every day and sometimes throughout the day. So when we talk about next spring, we're talking about different interest rates. And if the market continues to appreciate the way it does, that means the house you want to buy is more than likely more expensive next spring than it is this fall. So just purely waiting is not a strategy. It's a gamble. The ninth is that online payment calculators don't really show the whole picture. And so I'll often get the unenviable job of talking about reality when I'm talking to a buyer who saw a property online for $400,000 and it's advertising an unrealistically low monthly payment, maybe $2,000 a month. And what they didn't understand was that if you look way down at the bottom of the page and you click another button and you click through another one, you'll find how they calculated that, which is with a large down payment, and this payment doesn't include taxes and insurance or mortgage insurance. What I think is even worse is the affordability calculators that are available online, because those also don't tell the full story. They might put out a definitive debt-to-income ratio. And in reality, in today's world, debt-to-income ratios really fluctuate on many different factors. And so to think that online you're going to be able to tell what you can qualify for, realistically, you can't. It's something we can only find out during the pre-approval process. We run it through some software in order to find it out for you. And then the 10th, and this is the real mistake, buyers will self-disqualify. And by that, I mean they'll research and find something online that says, oh, this type of financial situation you can't qualify in. And rather than calling their mortgage lender and finding out, what the actual information is, having a simple conversation, maybe applying online, instead of doing all of that, which is free, a buyer will sometimes self-disqualify because of some errant information that they found online. I had a buyer once that waited 10 years after a bankruptcy before they could gather the courage to call me. And when I told them that because they're a veteran, I could have helped them 8 years ago, they were really disappointed that they didn't make that call a long time ago. Affordability is not a simple calculation. It's really something that we need to get your credit information and your income and assets, put it through our software, which can help us decide what you can afford. And then we have a real conversation about whether that's realistic for you or not. If you like today's video, give it a thumbs up and be sure to subscribe so that you don't miss the next one. Look forward to seeing you next time.